Welcome to the Explainer. Today, we're diving into a seriously unusual data set. We are dissecting the gold market commitments of traders report for the week ending June 2nd, 2026. And look, right off the bat, I'll tell you, these numbers are showing the most extreme, alarming, and frankly dangerous structural imbalance we've tracked in this entire 7-week cycle. We're essentially looking at a market time bomb. Okay, let's just drop this massive number right out of the gate. 298,370. This isn't just some random data point. It is a record-breaking gap between opposing market forces. I really want to emphasize this to establish the sheer scale of the anomaly we're dealing with today. We're looking at a structural imbalance that's actually far worse than what we saw at the previous peak back in mid-May. The stakes here literally couldn't be higher. Just listen to this direct quote from the executive summary of the report. A violent, catastrophic liquidation event is now virtually certain. The only question is timing. The market right now is an absolute pressure cooker, and today we're going to unpack exactly why that lid is about to blow completely off. Let's move into Section 1, the ultimate speculative surge. Let's see exactly who's fueling this impending storm. Check out what managed money, basically your trend-following hedge funds, are doing. Everyone expected a speculative flush, right? Well, actually, scratch that, because they did the exact opposite. They aggressively doubled down. In a massive single-week explosion, they covered shorts and piled on new longs, driving their net long position up by nearly 15,000 contracts. That pushes their total net long to a brand new all-time high of over 112,000. The long-to-short ratio has blown out to a mind-boggling 7.5 to 1. Look, this is not a healthy market trend. It's a full-blown speculative mania providing absolute maximum fuel for a huge sell-off. All right, Section 2, the market players. This is where it gets into a fascinating zero-sum war. On one side, you have managed money acting as the stubborn true believers, just manic, buying and doubling down on their long positions. And then, on the exact opposite side, you have the swap dealers, the giant bullion banks. For the past 2 weeks, these banks were actually covering their shorts, but suddenly, they violently reversed course. Now, they're ruthlessly defending the short side and completely rebuilding their fortress. And they did it fast. In just one single week, these giant banks added over 18,000 new short contracts. That's the largest single-week addition of the entire cycle. Because of this massive move, they now control an astonishing 65.5% of all short open interest. So that wall of defense they were slowly taking down, yeah, it's totally rebuilt, and it's taller and stronger than almost ever before. But you might be wondering, what about the little guy? Well, while this massive institutional war is raging, retail traders are quietly sneaking out the back door. They're actually following the expected washout script, consistently flushing their net long positions down to around 30,000 contracts. They are slowly and smartly stepping away from the battlefield, while the giants dig their heels in. Moving on to Section 3, the Great Contraction. Let's talk about liquidity drying up. Since that May 19th peak, total open interest has absolutely plummeted. We're talking a 14% drop over just 3 weeks. To put that into perspective, the market just shed over 5.3 million ounces of gold equivalent futures positions. Total open interest is sitting at its lowest level since before the April data even started. So this brings up an incredible paradox. You really gotta ask yourself, how is open interest completely collapsing, signaling a massive exit of participants, while at the exact same time, speculative excess from those hedge funds is hitting new historic extremes? It's highly unusual, and it makes this specific contraction incredibly dangerous. Well, here's the answer. As retail and spread traders flee and thin out the market's liquidity, those stubborn hedge funds are just doubling down. They're absorbing the remaining contracts. So the total number of bets in the market is shrinking rapidly, but the bets that do remain are overwhelmingly, dangerously long, and they're concentrated into fewer and fewer hands. It's a very precarious spot. Which brings us right into Section 4, the defining confrontation. Tracking this zero-sum war over the last few weeks reveals a pretty staggering trend. Remember that massive number we started with? As of June 2nd, the gap between managed money longs and swap dealer shorts has blown out to an absolute all-time record of 298,370 contracts. These two opposing forces are more committed right now than at any point in this entire cycle, and mathematically, one of them is going to be catastrophically wrong.
What's really alarming here is that every single roadmap for a safe market entry has just been thrown out the window. All the established triggers we've been watching, they failed catastrophically. The target to safely enter was for managed money longs to drop to 70,000. Instead, they exploded to over 112,000. Swap dealer shorts were supposed to drop to 165,000. Instead, they skyrocketed to over 186,000. Literally every single safety metric moved decisively in the exact wrong direction.
So, how does this all resolve? Well, the data outlines an inevitable directional timeline. In the short term, like the next 1 to 3 weeks, a sharp, violent crash targeting these overextended hedge funds is virtually certain as liquidity dries up. Moving into weeks 4 through 8, we're looking at a brutal but complete washout as those funds are forced into liquidation. But hey, here's the silver lining. Post-flush, because this structural imbalance was such a historic anomaly, the resolution actually sets up the opportunity of a lifetime. A massive, powerful rally is going to follow that purge.
Finally, Section 5, your action plan. What does this mean for your money right now? The mandate from the report is stark, and it's very clear. Number 1, stay in cash. The market has honestly never been more dangerous for long entries. Number 2, do not short gold. The giant banks are already heavily short, and the long-term bullish case remains completely intact. Trying to short into a potential squeeze right now is basically financial suicide. And number 3, prepare for the ultimate buying opportunity once the flush is totally complete.
To make sure you capture that opportunity, you need to watch for 3 concrete signals. Step 1, keep your eyes glued to the upcoming June 9th COT report release. Step 2, look for the very first crack. Specifically, you want to see a drop of 10,000 or more contracts in managed money net longs. Step 3, wait for a second consecutive week of flushing. That confirms the capitulation is officially underway.
I want to wrap up this explainer by leaving you with a highly visceral metaphor from the final verdict of the report. Do not be the last one into this burning building. Stand outside with water ready and wait for the fire to burn itself out. The structural integrity of the gold market is being tested like never before. So, when the smoke finally clears, are you going to be positioned to capitalize on the ashes, or will you be caught in the collapse? Thank you so much for joining me today, and as always, stay vigilant.